Welcome to Goldstone Finvest. I am Prabhat Majumdar and I will share market updates of Friday. On Friday, last market day of February, Nifty saw its fourth biggest loss in absolute terms and formed a large bearish candle that resembled a long black day formation on the daily charts. A sharp across the board sell-off wreaked havoc in the Indian equity market, dragging the benchmark Sensex down by 2149 points in intraday trade, its worst performance since May 2020. Rising bond yields, geopolitical tensions and concerns over inflation weighed on the market. At close, the Sensex was 1939 points down at 49,099, while the Nifty was down by 568 points at 14,529. The Nifty formed a strong bearish candle on the daily scale, indicating that the bears were in control of the market through the day. The market breadth was largely in the favor of the bears with a 2:1 ratio. Thus, analysts analyzed that the Nifty formed a bearish island reversal gap pattern on the daily time frame, with gap up and gap down near 15,008 to 15,065 zones in the last two sessions. After opening gap up down at 14,888, the index extended losses to hit the day's low of 14,467. It signed off the session at 14,529, which was down by almost 568 points. Our experts studied that Friday's gap down opening as a follow through to the last Thursday's gap up opening resulted in a bearish formation called abandoned baby on candlestick charts, which is popularly known as island reversal in conventional technical charting. Our experts researched that domestic markets stumbled in the line with global trend triggered by a sharp rise in bond yields. Increasing geopolitical tension between the US and Syria aggravated the selling. Q3 GDP data, which is to be released today, also added volatility in the Indian market. Thus, year-high US bond yields, which raised fears of FII outflow and rising oil prices, hit the sentiment as the index declined 3% for the week. Banking and financials were the biggest losers, followed by auto, IT, FMCG and metals. The Nifty mid-cap and small-cap indices fared better than the benchmark in Friday trading session. Mid and small caps outperformed their larger peers. The BSE mid-cap and small-cap indices fell 1.75% and 0.74% respectively. India VIX moved up sharply from approximately 22 to 28 points, indicating a tight grip of the bears. VIX touched the intraday high of almost 29, its highest level in 169 trading sessions. Looking at the options data, the option data was scattered at different strikes. Maximum put open interest was at 14,000, followed by 13,500 strike, while maximum call open interest was at 16,000, followed by 16,500 strike. The data indicates that the Nifty could see a trading range of 14,000 to 15,000 in the coming sessions. Apart from the said gap area, there seems to be a confluence of additional support points in this zone, like the 50-day exponential moving average with a value present around 14,400 levels. Hence, a near-term bounce can be expected from the zone of 14,460 to 14,300 levels. It was researched by our experts. On Friday, the Bank Nifty opened gap down at 35,806 and hit the day's low of 34,658. Weakness across the street swept the banking index, which ended the day 1745.40 points lower at 34,803. The index, which corrected 2.9% for the week, formed a strong bearish candle on a daily scale and weekly scales. Thus, Having a quick overview of the market, all sectoral indices ended in the red on NSE. With the Nifty Financial Services down by 4.93% and Nifty Bank down by 4.78% and Nifty Private Bank down by 4.67%, ending as the top losers. A long build-up was seen in stocks such as Trent, Nalco, SAIL and Alchem, while a short build-up was seen in stocks such as Shriram Transport Finance, RBL Bank and Mahindra. Analysts suggest that if there is a strong reversal, if the Nifty breaks 14,300, then it can fall below the 14,000 mark in the coming sessions. The trend seems to have decisively turned in favor of the bears. Our team advised positional traders to short the rally, preferably in the 14,650 to 14,700 zone, with a stop above 14,920 on a closing basis and look for bigger targets. It was inevitable that the index would revisit and bridge a bullish gap zone registered on February 2, present between 14,469 to 14,336 levels. But as the tide seems to have turned in favor of the bears, a close below 14,300 can eventually drag the index to 13,960. Thus, researchers further added that now, till market remains below 14,650 zones, weakness could be seen towards 14,400 to 14,300 zone, while on the upside, hurdles are seen at 14,750 and 14,850 zones. The recent upside bounce was negated sharply on February 26 and the short-term trend has turned down. Thus, our team predicts that the further slide towards the next crucial supports of around 14,350 to 14,300 can be expected in the coming few sessions before any upside bounce. On the upside, stiff resistance is likely at 14,640. Although negative, mid and small caps outperform their larger indices, showing investor confidence. The market will gain momentum as the global market is expected to stabilize, support by accommodative monetary policy and a growing economy. Till the Bank Nifty remains below 35,500 levels, weakness could be seen towards 34,000 and 33,333, while on the upside, key hurdle is seen at 36,000. As stated by Goldstone experts, traders should trade extremely cautiously with strict stop losses and should follow support and resistance levels on strict basis. Our team advised positional traders to short the rally, follow support and resistance levels along with trading call as published on our Telegram channel. For regular update, like, share and subscribe our YouTube and Telegram channel, and also follow us on Twitter and Instagram. Also be a part of our Facebook family. Views by Goldstone Invest. Let's build fortune together.